All right, welcome everyone. Thank you for attending. My name is Si Wing Yi from the Yi Real Estate Network, and my special guest is Mr. Richard Advani, and we are going to talk about something very, very important. We can talk about investment loan programs, and I know what you're thinking. You're thinking that as a typical, cookie cutter investment loan programs, but it's not, because Mr. Richard Advani from Supreme Lending, he has some very creative program for many type of borrowers, not just the mainstream, full doc W-2 and all that, the cookie cutter loan program. So you will be very, very surprised that there are many scenarios where financing can work for you, whether you're self-employed or you do not necessarily have the necessary full doc information that can you think you may not qualify. So you'd be surprised. But before Richard gets started, I just want to mention that Richard and I have done business for a very, very long time. Of course, as you know, we specialize, my company, the Real Estate Network, in helping out-of-state investors buy turnkey off-market cash flow properties in the best locations in the country, mainly South and Southeast and the Midwest, with a number of works. And Richard, over the years, he has cultivated a tremendous amount of relationship with not only real estate investment clubs such as my organization, but he have a network with many other large real estate investment clubs throughout California and different part of the country. So Richard Advani and his company, Supreme Lending, is really the top 1% of all lending companies out there. And his specialty is investment loans for motivated investors, although he does loans for the owner-occupied primary home buyers as well. And he and I is based in California. Once again, we work all many different areas in the country. Needless to say, Richard and his company and his staff provide outstanding client service. He understands the challenges associated with investors, and he has many great loan programs. His company, his loans deliver on a timely basis. And he's just have been serving many investors, get a whole bunch of referrals. And Mr. Advani is super busy doing so many type of different financing for investors. So we are very, very blessed to work with him. We have no hesitation to refer him our clients to do financing to buy 1 to 4 units, especially. All right, so enough said. So let's go through this tremendous, very valuable, very great lending program. So without further ado, Mr. Richard Advani, go and take it away.
Thanks for the warm introduction, C-Wing, and yeah, nice to talk to everyone again. So basically what we're going to kind of cover today is just a recap on programs that we have available. As C-Wing mentioned, we've been working together a long time. I've been in the mortgage business a little over 15 years at this point. And, about 13 years ago is when I purchased my first rental property and kind of decided to start specializing and working with investors. So I've written thousands and thousands and thousands of investor loans at this point, and have, created one of the top investor-friendly teams really nationally around the country. In January of this year, we moved over to Supreme Lending, and it was a good transition for a couple of reasons. One of them, of course, is that before we were limited to just conventional loans. And while conventional loans are a great option and do offer the most attractive interest rates, a lot of times our clients would hit 10 finance properties and, we wouldn't have an alternative, or, they may not have qualified income-wise for a traditional Fannie Mae conventional loan, in which case, once again, we would not be able to help them. And now we have access to all kinds of cool options, including loans for over 10 finance properties, including loans for, self-employed people, low to no income documentation, and all kinds of other cool things. So what I'm going to do today is cover briefly the conventional loan options, the non-traditional loan options, as well as, what's prevalent right now for a lot of investors is capturing some of the equity on rental properties they already have. That way they can redeploy and purchase additional rentals. So we will cover a couple different ways of capturing cash out as well. But between my team and I, we are licensed pretty much in every market across the country. Obviously, we do primary homes as well, in addition to rental purchases and or refinances. So please keep us in mind. It's very easy to get a quick quote if you are considering any type of financing. But moving on to the PowerPoint here, first thing we'll talk about is the Fannie Mae lending guidelines. So with Fannie Mae, there we go. So with Fannie Mae, firstly, we are limited to a total of 10 loans to a customer. Generally, you need to have a 660 credit score. And believe it or not, with the Fannie Mae loans, you can actually go, all the way up to almost a 50% debt to income ratio, which is, pretty incredible. Interest rates on these programs are, generally lower than the non-traditional programs, which we cover. So typically when we have a new client consultation, we'll determine what you qualify for. And our first objective is to qualify you for these Fannie Mae programs. Now, this PowerPoint is probably about a month and a half old. In the last 45 days, rates have gone up pretty significantly. The rates shown here, I'd say they're probably 1/4 to 3/8% higher today than they were based on what you could see with this flyer. Generally for Fannie Mae loans, you do need to provide all your income documentation. You have to kind of fit in that box of what conventional guidelines are. However, once again, they are, typically the best path forward in terms of maximizing interest rates and getting the best overall terms. Generally for these Fannie Mae loans, they are 30-year fixed, of course, and they do not have prepayment penalties. So within the conventional space, moving to cash out refinancing, firstly, there's two ways really to capture equity on a property you already own, or, for example, a property that you purchase in cash. One of them is a first mortgage, a 30-year fixed, where basically you refinance the property. If there's any liens, we'll pay off those liens, and then we'll give you, obviously, cash proceeds. Generally, we can go up to 75% of the home's value. You don't, contrary to what a lot of people believe, you don't need to wait 6 months to cash out of a property you buy in cash. You can do it as soon as the next day, really. You have to document the funds to close, used to purchase the property. But on top of that, you also need to, your total cash proceeds can't exceed how much you paid for the property. But it is an option to immediately pull cash from the property. And also, one thing to keep in mind, there are no restrictions on what the cash out can be used for as well, which is great. Although most of the time our investors are using them to purchase additional real estate. And then the second form of way you can access equity is through equity lines, a home equity line. We actually don't offer home equity lines. Generally, in my eyes, they are more of a short-term solution. So if you plan on borrowing a chunk of money and repaying it in a short period of time, it is a good option to have. However, what we offer is more of a secure long-term financing. So if you guys do have equity and you're kind of limited on cash in terms of continuing to invest, a cash out loan is a very good option for you to access some of that. Wing, anything you want to add to that in terms of capturing equity and best ways to do it?
No, yeah, 75% loan to value. I mean, a lot of the investors who have purchased in good markets, for example, through our network in Austin and Central Texas and in Southwest Florida and Central Florida and even North Carolina, if you purchase within a year ago, even you have seen your property increase in value, 10, 20, even 30%, even more. And then, and then if you initially put down 20% to buy the rental property, now you have like 40% loan to value. So yeah, it behooves you from a strategic perspective. If you're a very motivated investor, I mean, you should not hesitate to to look at your existing rental property portfolio from those locations in which you purchased within the last couple of years, and do a max cash out refinance from your various rental properties and leverage into more rental properties. That's how you build wealth. That is a smart way of doing it. And Richard and I have done that, and will continue to help you to leverage your wealth through great lending programs. So yeah, cash out refinance is up and coming, is happening right now. We have seen some of my investors are, that's why the intention to do so. And I'm sure, Richard, you are seeing investors coming back to you to do some cash out refi with relatively easy 75% or lower loan to value ratio. So that's a great opportunity to build wealth rather quickly. All right. Yeah.
Absolutely. So another thing to cover are 1031 exchanges, something also that's very, very prevalent in the market we're in. You have two options if you want to capture equity out of your home. One is to refinance it. The other one is to sell it through a 1031 and purchase additional properties. It is very important to work with a lender and a team that are familiar with 1031 exchanges. A lot of times there's hundreds of thousands of dollars of tax implications to making sure you close and making sure that no mistakes are made. We handle on average probably 6 to 10 1031 exchange properties a month, if not more. And having someone to actually keep everything on the path is very important, especially when you're buying in multiple markets, like a lot of people are. If you're buying, a couple in different states, having a single point of contact that's kind of keeping everything corralled is important. And, within my team itself, I have, one person, Jill, who's dedicated just to staying on top of appraisals, staying on top of the transactions, making sure that, title companies, escrow companies are updated. And that's very, very important. Once again, working with someone who does have experience. In terms of qualification or any differences, there are no differences in terms of the loan as far as qualifying. We just look at 1031 exchanges, obviously, as your bank account, right? The funds you have with them, and then we keep them updated throughout the process to ensure that everything moves smoothly and on time. Once again, if you're interested in 1031s, feel free to reach out to us. We have lots of experience with them. Now talking a little bit about non-conventional, non-traditional loans. As I mentioned earlier, they're really cool because they give us the option to go over 10 finance properties. They give us the option to vest in an LLC. They also give us interest-only options, as well as options for people who may not otherwise qualify. And the best part of all is generally they're, fixed rates, which is amazing. And as what we've seen is as conventional rates keep rising, these non-traditional rates really haven't changed. So that gap between them is getting smaller by the day. And you can, of course, apply these short-term rental loans to, these non-traditional loans to short-term rentals as well. So with these over 10 non-QM loans, there are no limits on how many finance properties you have. We just got someone approved for, I think their 49th and 50th finance property, which is unbelievable. As you can imagine, they didn't think they would be able to get any more. And currently we have someone in process who has 120 finance properties. So stay tuned on that one. Hopefully in a month, we'll have a positive closing update. And as I mentioned, they are fixed rates. Now we do have an interest only option, which takes the term to 40 years, the first 10 years of which are interest only. And then of course, the remaining 30 years are amortized. That is fixed though throughout the duration, which is obviously awesome as well. So in terms of these over 10 finance property loans, you can qualify with as little as 20% down. In fact, that's generally recommended because 25% down only makes 1/8% difference on interest rate. So not a huge difference on rate. Typically with these, you're going to be in the mid 4% range. These non-traditional loans do have a minimum of 2 points on them. So you are going to pay points, and there are 3-year prepayment penalties as well. Now, these 3-year prepayment penalties amount to 6 months of interest, so it's not a massive amount. And for most of us out there, we plan on holding on to the properties obviously longer than 3 years. So shouldn't affect most of us, but there are 3-year prepayment penalties on there. In terms of qualifications, believe it or not, if you own a primary home, you don't really have any income requirements. So you don't even state income on the application. These loans are based on the asset and the property themselves. And generally they have to be at least cash flow break even, which is most anything we're buying. If they're not cash flow break even, then you may need to put 25% down. But assuming you have good credit and assuming you have, the money for the down payment and you own a primary home, it's a breeze to get these loans. They do take about 45 days to close, but they are super, super easy and straightforward. And Seawing, anything you want to add really on these non-traditional loans? I know, me being able to offer them now is something that's has opened up access to yourself and your group. And we've been talking about them for the longest time when I was at Wells Fargo because we didn't have access to them. But what are your thoughts?
Yeah, I mean, that's interesting. And I bet you a lot of people listening to this podcast are unaware that you can still get some favorable loan programs even after the max Fannie Mae lending guidelines. But even though you mentioned this non-qualified, or QM means non-QM means non-qualified mortgage. That's what it means, right?
That's correct.
Yeah, I just want to make sure in case someone out there are thinking, what does QM mean? Anyway, so my quick comment is that even for those non-qualified investors getting these type of loans with the rates in the mid-4s, now you have to understand, I mean, most of our investors, they go buy cash flow property, single family home. Now, if you buy a property, for example, $350,000 or less, a single family home rental property, even with 20% down at a non-qualified lending program in the mid-4s, you're thinking, yeah, you can still cash flow because a 350K property or slightly lower that we offer within the market that we offer, Texas, Florida, and North Carolina, Raleigh, for example. I mean, if the property rents, if the renters are paying $2,200 or $2,300 on a 350K purchase price and the loan is in the mid-4s, you can still cash flow, right? You can still cash flow. It's not like you buying a $1 million owner occupied property. Yeah, the difference between 3.5 and 4.5 rate are pretty significant on your mortgage payment. But investors, we know the numbers, right? We know the sweet spot of how to buy, and the difference between 3.5 and 4.5% between traditional Fannie Mae lending guideline versus a non-qualified investment loans that we just talked about are not that much of a difference. You can still cash flow, not as much as on a better loan, but it should not stop you from proceeding with this non-qualified mid-4 rates for those investors that have to resort to this type of loan. So yeah, okay. That's it.
Perfect. All right, I think that's the end of the at least the side presentation on my end.
Really? Yeah, you have nothing else left?
No, I think that's it.
Wow, that's interesting.
Right, we covered Fannie Mae. You can edit this part, obviously, where we're talking, right? Yeah.
Yeah, that's fine. Okay, let's get back to the how to get back to my view for me.
So I need to stop sharing.
Side by side mode. Okay, all right.
There it is.
Okay, we're back to normal. All right, so yeah, I mean that's the nut and bolt of it. It's a big picture recap. So my recap is such that if you are an investor, if you have the money, if you want to consistently buy property using the 10 mortgage Fannie Mae lending guideline per borrower. For if you have a husband and wife or significant other, both of you qualified for a loan, investment loans, that is, each one of you should buy 10 to get 10 mortgages under your name. Then when you're done with your 10 mortgage, then the other spouse can buy the next 10 property with a 10 mortgage limit. So you can, for for a husband and wife, you can have a total of 20 mortgages under the favorable Fannie Mae lending guideline. And if you want to buy more, if you have the money to buy more, do the non-qualified route. Oh, one thing we failed to mention, I think, is on one of the slides we talk about the self-employed type of borrowers. I mean, what are the challenges self-employed without a W-2 that may not have the best full doc loan possible for it? So what option do they have as an investor?
Yeah, absolutely. So for the non-traditional program, you don't even state employment. If you own a primary home and you have good credit, then you don't even state employment in the employment section. So it's a beautiful program for self-employed people. Some of our clients that are taking advantage of this program are actually even under the Fannie Mae limit, but they're just taking this program and basically saying, hey, I'll pay a little premium and interest rate to not have to go through and provide my profit and loss and go through that underwriting process. So it is a great program for self-employed people.
Yeah, especially, I notice myself, you and I are self-employed, but I don't have a W-2, I have a Schedule C. So a lot of people in the self-employed space, they write off so much expenses that on the Schedule C, self-employed income and loss, they show very little income. So they can save money on taxes, but that could be a detriment for loan qualification. So your program can help these individuals, to overcome that. So let me see what else I have to say. I think that's. Oh yeah. By the way, if you max out on your 10 Fannie Mae limit, the past perception is that you can do to go beyond 10 loan Fannie Mae guideline, you have to go commercial 5 or more units. This concept is no longer unnecessary. You can use the non-qualified program that you and I talked about, Richard, the rates at mid-4, fixed rates at mid-4s. You can still continue to buy single-family home rentals or duplex or triplex or fourplex. You don't have to resort to 5 units commercial investing just because you reach the maximum 10 Fannie Mae lending guidelines. Do you agree with that, Richard?
Yeah, absolutely. Yeah, you can utilize this product on a single family home all the way up to 4 units, which is awesome. You don't have to go in buy commercial properties.
Yeah, one final point is this 10 maximum Fannie Mae lending guideline. Ideally, you can get almost similar rates, favorable rates, whether you buy a single family home rental or duplex, triplex, or fourplex. That's considered one loan. You buy a fourplex with 4 units, in a commercial building, with 4 doors. That's only qualified as one mortgage under the Fannie Mae limit guideline. So technically speaking, what if, and it's not easy to do, what if you want to buy 10 fourplex to maximize the 10 10 loan limit Fannie Mae? You can, at the end of the day, when you finish up your 10 max, you can have, with 10 fourplexes, you have 40 doors. You have 40 doors that you're able to purchase under your name to get the Fannie Mae guideline. Then, and I mean, that's not reality for some people, but some people maybe it is reality. So
hey, and then if you're married, that's 80 doors.
Exactly, 80 doors on 10 loan maximum limit at the most favorable interest rate in historical rates. Historical low interest rate. This is mind-boggling. I mean, this is like the government is almost giving you free money. I mean, you could, Richard. So you and I, in this, at this time right now, 2021, moving into the year 2022, still get historical low rates for not only for investors but home owner occupied buyers. We know the rate's going to go up steadily in the next few years, and so show the urgency. Use debt, good debt, to your advantage. Leverage through it, and then 10, 15, 20 years later, when you have this portfolio of homes continue to increase equity-wise over time, right? Buy and hold long term, right? That's the key. Then, Richard, you and I acknowledge the rental rates. The renters are paying amazing increases. I mean, we're seeing 10 to 20% increases in rental rates all over the country because of a lack of homes to rent for many renters out there. So as an investor, I mean, what an amazing time, right, to buy a property. Even though the properties are increasing 5, 10, 50% appreciation the last few years, but the rent is also increasing along the way, and you can still cash flow in this amazing times for investors. So don't let all the negativity out there in a mass media try to try to scare you away from entering the real estate market. So so that's my recap. So Richard, what is your final words on this before we take it? We finish.
Basically, I mean, you did a great recap. There's every solution out there right now in terms of financing, and rates are extremely, extremely low historically. And, if you think that, oh, well, the market's gone up a lot and, I want to wait for the next downturn. Well, number one, you don't know when or if that's going to happen. And number two is, let's say property values drop 10%, 15%, right? If rates are 1.5% higher than they are today, you're still in the negative at that point, even if you would have bought the house cheaper. So, let the interest rates and the overall rate environment factor into your overall strategy as it relates to buying real estate. Because, even buying at an appreciated market, if you're buying with, interest rates in the threes, then, I'm pretty sure inflation's way higher than that right now, and that's free money then at that point. And that's how you build wealth. So,
yeah, Richard, absolutely, you are on the same page. And so, of course, at the bottom of the video, we have the Richard Advani's contact information. Feel free to reach out to him and work with him and his great staff, and so they can help you finance your way for investment properties for future wealth that all of us deserve. Thank you so much, Mr. Richard Advani from Supreme Lending. Once again, we'll invite you back, hopefully on a weekly basis, given how busy you are. We have many other topics to discuss around real estate, not just loans. So thank you for your time, Richard. I know you're busy. Thank you so much. This is Si-Wing Yi from the Yi Real Estate Network. Have a blessed day. Goodbye.